Good morning, good afternoon, and good evening. It's 6:03 p.m., May the 4th, Thursday. And welcome to our latest episode. This is Mark Yu,
And Wawi Santos made the fourth be with you.
May the 4th, for those
I
who
can't
are
help myself to say
big
that.
Star Wars fan. It's that the day of the year that you can wear costume to work, I guess, if your workplace
Yes.
has a Star Wars favorite character and not be written up.
And don't forget, tomorrow is Cinco de Mayo. Time to celebrate.
Another celebratory day. Well, here we are. Apple just posted their earnings, another beat. We're going to take a look at those numbers. And this is our latest episode, 76, Defy Expectations. But yep, before we jump on that, of course, who cannot miss the third biggest bank failure or this in history with the First Republic. I guess it's the second biggest bank failure that just
Mhm.
happened at the start of the week when FDIC took over, seized its assets, and eventually handed on to the largest bank in the United States, which is JP Morgan. So, what a way to start the week. So, we're going to just take a look, of course, the some figures from the latest downfall from the financing sector. We're going to take a look at our weekly data as well, the sentiments in the stock market in a little bit of twist on this episode. So, as of right now, I think Huawei and for those who are following the market closely, looks like the banking sector or the financing part of things have been taking a huge hit, even despite the recent calming reassurance provided by JP Morgan by taking over FRC or First Republic. So this is one of the index, the S&P regional banks industry. This is ticker KRE. So we are not saying that this would be the bottom or advising any investment tips right now, but you could tell since the start of the year, the index is down 35%. Quite a huge hit. So what comprises this are, of course, little banks, a lot less bigger than the JP Morgans, but big enough to topple incite fear among the industry finance. So KRE, the top constituents, according to their filings, is New York Community Bank. Obviously, it's financials. M&T Bank, Regions Financials, Citizens Financial, First Horizon, Truist, Huntington Bank Shares, Cullen/Frost, East West Bancorp, and Western Alliance. So all of these banks suffered a huge hit this week, despite the recent acquisition of JP Morgan, which was supposed to calm things down. As of today, actually, as we close on our market, um, 50%, one company, PacWest Bancorp, dropped 50% just today, just because it published, I think, late last evening when Bloomberg came out with a report that PacWest was seeking alternatives like selling themselves or looking for mergers because of their continuous outflow in deposits, followed by Western Alliance, down 38% in just one day, and followed by First Horizon. So First Horizon, there was a news that Toronto Dominion, which is a Canadian bank, one of their biggest, got cold feet and withdrew their acquisition of First Horizon. That's why it dropped quite a huge amount, 33% today, and a lot more banking shares that fell quite little less, but still a huge hit. So after the 33% drop from First Horizon due to a failed merger, the next biggest drop was 14.7% from Affinity Bank shares, and then Huntington, and then Comerica, which is also a bank a big bank, which is I here in South Texas, I've been seeing it at least a couple of branches every here and there. So these are just not like, you know, little banks. They're like big regional banks being hit despite the recent turmoil that was supposed to be uh, terminated or at least tampered down after the JP Morgan acquisition. So as of right now, we're just looking at a chart for the KRE, which is the index of these regional banks, which are the worst performers today. You can see the big drop coming up on March 6th when all hell break loose. When I think what was the bank's name? The Silver Bank and Silicon Valley Bank.
Silicon Valley Bank.
Yeah,
Yes.
it was the drop actually happened on March 9th, and it never recovered from there. So it dropped from $56 a piece down to 36 or $35 a share. But you can tell if you're gonna look at it technically, you're gonna take a look at the RSI if we have actually probably hit the bottom. So during those panicky times, RSI actually hit the lowest at 11.58 points on March 13th. So technically, we should have seen like a bottom there, but nonetheless, it still kept going down. So it kind of settled from March 13th up to April 25th. And then suddenly, boom, another sell-off because of this First Republic. They had about at least close to a month, more than a month to settle things down, but they weren't able to. And then now they had to be seized by FDIC. So in terms of RSI, I don't think it's a valuable tool right now to indicate if there's a bottom already set in on the regional banking KRE ETF. Looks like we just started again to take a deep dive on the RSI. So another chart. This is something I find relevant and helpful from Reuters graphic. So regional lenders deposit. Well, this is as of March 31st, which I picked up on one of their recent reports. So a lot of Q1 to Q4 deposits that had changed over the course of the recent quarter. So the difference in terms of billions, you could see Truist still has a leading deposits in turn, a lot of deposits remaining. So not much difference there. Charles Schwab, despite the panic, actually Charles Schwab shares is also one of the brokerage that got hit pretty badly, along with other banks, because they have a lot of exposure to flying deposits. So they're actually down 42% since the start of the year. But if we're going to take a look at its interior or fundamentals, they actually lost about 41 billion in deposits as of their first quarter report. Bank of New York Mellon lost 8 billion. State Street lost 6.4. So going down the list, First Republic definitely is the most alarming one. They lost 101.96 billion in deposits in the recent quarter. So aside from them, it's actually Charles Schwab, second biggest loser in terms of their deposits. This is among regional lenders. So Charles Schwab, quite an alarming information right here. And next would be Citizens Financial, losing 8.5 billion, followed by Bank of New York Mellon, lost 8.2, followed by State Street, 6.4, and then Truist Financial lost 5 billion in deposits. So I don't see, Western Alliance, 6.1 billion. So I would rank it as the most in a delicate position would be First Republic, of course, followed by Charles Schwab. So definitely something to keep an eye on. And then Bank of New York Mellon, which is 8 billion, lost 8 billion in deposits. Citizens Financials as well, State Street as well, and Western Alliance. But they among the following, Western Alliance has the least amount of deposits in terms of if they're gonna rank
Exposure. Yeah.
exposure to these bank runs. The digital bank runs is what they say, because it's happening via split second because everybody now has access to these banks.
Mhm.
Um,
So we're gonna have more movements that are quick, faster moving fluctuations now that we have the digital transactions. And by the looks of it, once we get the Fed now and maybe retail digital currency and wholesale digital currency, these type of movements will be much faster during the initial phases of the transition.
yeah, yes. Well, it's quite delicate right now. Not even just stock prices are going down. Even according to this new Bloomberg data or article, even the bond price of First Horizon, which Toronto Dominion decided to terminate as of this morning, its bond hit the lowest price on record, falling as much as about 27 cents on the dollar to 68 cents. So I guess it's a little bit delicate in terms of investing in regional banks at this point in time. According to Blair Schwido, head of investment grade at US Bancorp, quote unquote, the market would have wanted to see a bit more of a path forward in terms of cutting rates. It seems like the Fed wants to, at best, wait and observe, and at worst, reevaluate hiking in a few months. So for those who are not following, Jerome Powell came to the podium yesterday and again hiked up the rates 25 basis points. So a lot more tightening has been happening. He kind of signaled that he's wanting to really, uh, you know, well, it's not clear still, right, Wawi, from his statement. I do not see him actually saying that he's gonna halt raising rates, but it's more of the inflation. He's still sticking with a 2% target, whereas right
Mhm.
now where it's still 5%, more than double that. So
Mhm.
are we gonna see more banks folding up, being swallowed by JP Morgan?
That's a good question. Um, but it's backfiring. It's taken as negative by retail investors and depositors. That these banks are being taken over by bigger banks. So they're still, pulling their money out of banks, keeping their cash. Um, so there's a lot of fear in the market right now for sure. And I know those that are shorting the market are doing good today.
Yep. So this is just an article from Reuters, published 13 hours ago after the much anticipated Fed rate hike. So according to them, Fed's hiking pause may not signal all clear for US stocks. The end of a market punishing rate hiking cycle may be in sight, but uncertainty over stock valuations and the economic outlook is keeping investors on alert for more turbulence ahead. So the Fed, according to an investment strategist at Edward Jones, the Fed getting ready to move to the sidelines is one step, but it won't be a cure-all. According to this article, the S&P 500's forward price to earnings ratio of up to 18.2 times, compared with its historic average of 15.6 times, is still levels some investors say may be too pricey. So I guess we're still in the early innings, if anything, if you're anticipating to buy into the stock market. So
Uh, Now, if you're looking at prices, it's still, I think we're still kind of pricey on the S&P 500. So we'll have to wait a while. We probably need to see a bit more correction. If people are thinking about getting in at this time, I think it would be best to wait.
Right. So right now we're looking at the Federal Reserve Bank of New York leading indicator again. So probability of recession is still high. We are at 57.77%. And we're gonna see a recession in the next 12 months. Nothing has changed. It just
Mhm.
creeped up a little higher. So this is the CME Fed Watch tool. So I just found out about this. Actually, it now predicts that the Federal Reserve on June 14th won't do anything. They'll stay 80% of those who have been polled would stay on the same 500 basis points to 525. But if you click here on the topmost part, you can actually skip it and go to at least maybe December, November. See, each month you could tell. So if we go look at further, by July 26, experts are weighing in that the Federal Reserve would actually cut the rates. At least 60% are thinking that by July, the Fed would cut the rates by 25 basis points. And then by September, they're thinking another rate cut of 25 basis points. By November, they're thinking they're going to keep it at that level. So experts are now thinking that the Federal Reserve would start cutting rates July and September and keep it there. Yep, until November. And then by November, another rate cut. So we'll be looking at around 400 basis points, or at least 1% cut starting July till the end of the year. So that's quite a projection.
Mhm.
This could change in a snap, in a snap of a finger, if
Mhm.
more banks are dropping off the list. Alrighty, so just be careful with your portfolio exposure if you're exposed in the banks, I guess. So now we're gonna take a look at the survey, sentiment survey. So American Association of Individual Investors, where are we? As of yesterday, wow, it's the same as where we were. No kidding. In terms of bullishness, 24.1%. A lot less people are less bullish compared to a month ago, but a lot more people are turning more bearish.
Mhm.
All right, 44.9%. Wow. We are at the highest point of bearishness for the past 4 weeks. Fear and greed. So last week, me and Huawei did a recording. We were actually in the greed territory, 58 points. But now we are at neutral. And the market momentum, 125-day versus S&P 500, we have dipped a little bit, but we're still on the positive side of things. We haven't gone through that barrier since March 10th. So we're ongoing 6 more days and it'll be 2 months on the positive side
Mhm.
of things. And put in call options, elevated, of course. And we're gonna just take a look at the volatility. Not sure where the volatility is. There we go. Volatility for the past 5 days, it's up 19%. Whereas the S&P 500 for the past 5 days is down 1.66%. So definitely coincides with that. We're going to take a look at the NASDAQ, which is, tech heavyweight. We're looking at, for the past 5 days, it's down 151 points or 1.25%. Whereas the volatility in Nasdaq, it's up nearly 10%. So volatility is now breathing some air. It's going back to 20, whereas it was just as low as 15 points just last week. So it's really hard if you're gonna be betting one way or the other where the market is going. So I think that's the best way to do with this is always, stay invested and make sure that you're invested in companies that you have a high conviction in, or you won't be wary where it's gonna go tomorrow, or if it's gonna go like the way where FRIC went, which is straight into JP Morgan's belly.
Or invest in JP Morgan.
Right. The biggest
Well,
of them all.
yeah. So big banks have are in a good position right now. So far, stable. But what's on my radar is current drops in home prices in 5 U.S. metro compared to last year. Top 5 on my radar is Austin, Texas.
Mm-hmm.
Change in median sale price of 13.6%.
It's a drop.
And yeah, it's a drop of 13.6% in home prices. Seattle, Washington, drop of 9.5%. San Francisco, negative 8.9%. New York, negative 2.2%. And Pittsburgh, Pennsylvania, negative 5.4%. But still, no one is selling their homes.
Yeah. They don't want to get out because they got a low interest. That's why. So there's gonna be a tight inventory nonetheless. I
Still
guess,
a catch-22 for home buyers.
yeah, the biggest winner would be, in my opinion, would be the builders, because they're the ones who have the inventory. They're the ones who's gonna build. So they can demand prices actually bump it up a little bit more if there's more demand.
Yeah, they're needed. They're
Mm-hmm.
much needed.
Pulte Homes, actually, I was surprised. This company is nearly uh up 44% since the start of the year. And Toll Brothers, some of these builders are like just ranking it, delivering a lot of returns for the shareholders. It's up 23.5%.
As well as Lennar.
Lennar, yeah. NVR as well, 26. Despite a share price, $5,800 a piece, it's up 26%. And then Lennar, let's see. Lennar is up 22% since the start of the year. So builders is surprisingly where we would think when mortgage rates have started to increase, builders would take a hit, but no. They actually are one of the best performing
They're
sectors.
doing better.
Well, let's just take a look at the data here. Since the start of the year, where's real estate? Real estate as a group is actually down in terms of this graph. Negative, down 1.63%. It's still technology who's leading the way, which is interesting, up 17.5%. And the worst performing sector, energy, which is like the total reverse of last year. Energy was always and has always been up the top performing industry for last year, but now it's the worst performing sector. Oh, let's take a look at Exxon. Exxon, since the start of the year, it's down. Well, not really. It's flat, negative 0.44, while Chevron, another big company, this is a major Berkshire holding. It's down 10% since the start of the year. Also, let's take a look at Oxy. Occidental is one of Warren Buffett's favorite stock since the lockdown. It's down 3.85% since the start of the year. Not bad, but you'd think it would have been performing worse than that, but not really. They're staying in line. They're doing better than the banks. one way freely say. So for the fund flows, actually, this has been updated 6 days ago. Money market funds see big inflows last week. So a lot of cash from investors are heading into safety to money market. A net purchase of 42.68 billion. So for the year, money markets have taken at least $427.4 billion.
That's huge.
And this is a chart from Zero Hedge in Twitter. So we haven't seen this parabolic increase in such a short period of time, except for during the COVID lockdowns of the 2020. So
Mhm.
we are now at highest $5.3 trillion in money market.
Cash is going to where it's safe.
Right. Safe and getting some money in return, right? Because money markets is now yielding at 4%.
Mhm.
So meanwhile, global equity funds last week saw nearly 9 billion worth of net selling. Biggest weekly outflow in the past 4 weeks. Investors sold tech, healthcare funds, respectively. Look at this, while financials obtained a third weekly inflow, 489 million. So all this money right now are suffering. These new funds that just came in last week are now toasted because financials have taken a huge hit so far this week. Yeah. Well, not as bad as energy, believe it or not. Energy is still the worst performing sector for this week, followed by financials down 4%. So you can't really rely now that we're looking at the data on this alone, because if you're going to take a look at specifically what we just dove in earlier, the regional lenders, they're suffering big time.
Mhm.
A lot more for individual stocks.
A lot of negative news.
Yeah, for the past week alone, PacWest lost 70%. Let's see, worst performing for the past week. Obviously, First Republic, it's no longer trading, down 78. PacWest is closing in at 70%. Western Alliance, 52. First Horizon dumped by Toronto Dominion, 42%. Republic First Bank. I feel sad for this because I feel like they're just being like mistakenly similarly named to First Republic. Republic First Bank Corp. Down 42%. Home Street 42. A lot of banks. Even Comerica is down 24%. Oh well, we'll see how that goes. Hopefully there'll be the bleeding would stop eventually.
Mhm. Well, it's not just the regional banks, even the financial technology companies like SoFi and PayPal are affected.
Oh yes, I haven't seen those charts. We're gonna
Mhm.
take a look at PayPal, like you said, down 3.7%. Well, okay, I guess. Block. Block is down 6%. And SoFi would be oh, SoFi. SoFi would be down. Oh, it's up 8%. I think they beat some estimates. I'm not really sure. Don't quote me on that, I guess.
Mhm.
They just came out with a report recently. So next, we're gonna take a look at the Federal Reserve data in terms of their assets. So it's still going down, Huawei looks like.
Well, that's good. Um,
Mhm.
Maybe the CDS is starting to wind down.
Mhm.
They injected a lot of liquidity into the global market. So maybe the global market is stabilizing while ours is still in question. I'm sorry.
Right. And US job markets just came out earlier this morning. So US job markets, according to Reuters, it's softening, slumping productivity boosts labor costs. So jobless claims increase 13,000 to 242,000.
Okay, there's the lagging indicator. It's starting to happen. What the effect that the Fed wants is starting to show up now.
Right. Unemployment still probably is still in the low range.
Hmm. but it's gonna build up for sure. This is how it normally goes when the Fed hikes their rates.
Yeah. But yeah, nonetheless, according to this article, the labor market remains tight. There were 1.6 job openings for every unemployed person. So there's still plenty of jobs out there. And according to Federal Reserve Chairman Jerome Powell, quote unquote, the labor market remains very tight. But there were some signs that supply and demand in the labor market are coming back into better balance. Yep, layoffs are rising for sure. 67,000 job cuts in April.
Yeah, that's uh that's a hard thing to accept, but this is what they want. This is the effect that they're looking for.
Right. And according to the senior economist at BMO Capitals in Toronto, quote unquote, the Fed's potential rate pause is entirely conditional on making further progress in reducing inflationary pressures. Today's report marked the exact opposite. So this isn't saying that the Federal Reserve would cut anytime soon because unit labor costs, the price of labor per single unit of output surge at a 6.3% rate after increasing at the 3% pace in the fourth quarter. So it's still high. So labor costs are rising too quickly to be consistent with the Fed's 2% inflation target. So I guess we're not seeing any signs of potentially slowing down or cutting rates anytime soon because of that.
Mhm.
Alrighty, so I guess we're running out of time for our weekly recap. Just a single chart from a sentiment trader here. An interesting chart, actually. They're saying that, according to this chart, significant relative outperformance by the tech. Oh, sorry about that. Looks like we're about to see further upsurge, potentially because of the historical performance of this chart. So the 4-month rate of change spread in the technology sector. I gotta find the quote here. Give me 1 second. So technology industry as a sector looks, according to Sentiment Trader, looks poised to continue its winning ways. Over the last 4 months, the technology sector outperformed the equal weighted version by over 14%. So after similar performance gaps, such as this, technology stocks outperform all other sectors over the next 6 and 12 months, regardless of the weighting tech methodology. So according to Sentiment Trader, there's a big potential that technology could still continue to outperform on the next 6 to 12 months, basing it on this 4-month rate changes spread. So it's quite technical, but Sentiment Trader looks at each data, granular data on their chart, and it just shows that whenever it hits that target right there, or that line, 15%, technology sector continues to outmaneuver other industries. Meanwhile, the S&P 500 bears have reloaded their short. So the bears are very short on
They're
the
not.
S&P 500.
Yeah. Well, they're seeing a lot of opportunity, especially this week. So we'll we'll
Yep.
keep uh, we'll keep our eye on this. I think they're gonna have a lot more opportunity moving forward this second quarter.
Yeah, we'll see. Sell in May and go away. That's what they say. But they are definitely short. Not seen since 2011.
Hmm.
They're very short market.
Yeah, that's
And
very smart of them to do that.
yeah, and
Very smart of them.
And the last tidbit of this episode will be the money supply. So money supply is shrinking fast. It's shrinking at the fastest pace since at least 1960. So
Well,
this is quite alarming.
there
Shrinking
you go.
availability of loans. So we'll see how that goes. Oh, you know what? We actually didn't talk about Apple. So
Yeah,
so
Apple
Apple,
did great.
yeah, they beat estimates. So good thing we have Bloomberg data here. Apple's second quarter results, that's how they file their fiscal year. It's already second quarter for them. They beat the earnings per share, they beat the revenue, they beat the products revenue, and
Mhm.
they didn't beat the services revenue. So that's the only thing that they didn't beat. And if we're going to take a look at their performance after market, they're up 2.3% at $169 a share.
So this is good news for those index, S&P 500 index holders, and
Yep.
Apple holders.
Yep. You're definitely
And
going to be exposed if you're a passive investor on Apple. It's the largest company in the world, or second to Saudi Arabia's Aramco. But it looks like only services and iPhone generated growth on the second quarter. If you're going to take a look at it on a year-on-year basis compared to its same period last year. Services increased 5.5%, iPhone 1.5%. Oh,
interesting. There's a lot of movement away from PCs, laptops.
yep. And then,
I'm curious how much of this movement is going towards wearables.
yeah, well, we'll see how it goes. And they also announced a $90 billion stock buyback.
Oh my goodness.
I think Google came out with a $70 billion announcement. They're just trying to beat Google in every aspect.
Wow.
Well, I guess that does it for this week's recording. Thank you, Wowie, for making it fresh from the hospital,
Yes.
fresh from work.
Well, fresh from work, not being hospitalized.
Oh no, yeah, that's, that's another meeting, I guess.
Hmm.
Well, thank you guys for tuning in again. I guess we're gonna sign out. This is Mark Yu signing out.
And Wawi Santos signing out.